Hi there, it's Seth Wilcock at Nova Home Loans, and I wanted to send you a video because just with the volume of emails that we're getting, sometimes it's hard to just respond by typing a bunch of responses. So I figured I would, maybe change things up. Let's do a quick video because I want to let you know where we're at with your refinance. I know you reached out to me not too long ago about a refinance inquiry, and I wanted to explain, some of why it's taken a while to either get that quote to you, some of the changes and shifts that we're seeing in the marketplace right now. Ultimately, I have not forgotten about you, and I wanted to just pass along an update. I've got a lot of people reaching out right now, so I wanted to, just share a quick update. Kind of like in a mass distributed, like here's where we're at, and I'm still working on it, but hang in there with me a little bit longer, and please be patient. So this is going to be a little bit longer of a video because we have a lot to cover. I want to explain what's going on in the bond market, what's going on with interest rates, why quotes are taking a little longer to get out, and in some cases why things aren't being beneficial for people, whereas some people are refinancing. So there's just a number of different things going on, and I wanted to cover all of these topics in detail. So first, I want to talk about the Fed rate cut from this past Sunday, okay? Obviously, I'm sure you've heard about this. It's in the news, it's everywhere. It's impossible to open up, Facebook or social media and not see the headlines about the Fed rate cut. So what does that mean, right? When the Fed cut interest rates 1% and they dropped it to the benchmark of, 0 to 1/4%, what does that mean, right? Well, when the Fed does that, it's important to understand that they're really talking about the federal funds target rate, or the target federal funds rate, excuse me. What that does is that is the amount of money that they charge banks to borrow money from the Fed, whether that's for overnight trading or if the bank needs additional liquidity or capital, they could borrow that money from the Fed, and that is going to be the interest rate that the Fed is going to charge to the bank, okay? So when the Fed cuts rates to 0, know that that is the federal funds rate, that is not mortgage rates. Mortgage rates are entirely different. They are set, or they're based on day-to-day trading, what's going on, like with the economy in terms of inflation, employment numbers. This coronavirus is impacting things, but really when the Fed dropped interest rates, sometimes it can actually have the opposite effect to interest rates. Sometimes it can actually cause mortgage rates to go up, because what they're trying to do, or what the Fed's trying to do, is they're trying to encourage economic activity by dropping interest rates. When they do that, it makes everything more affordable, so they're trying to get people to go and spend money. But that doesn't really cure the coronavirus, though, so people don't want to go out and spend money. So even though this is what the Fed, this is what the Fed can do, this is one of the tools in their arsenal. Unfortunately, they're not in the medical field. They can't just solve the coronavirus, but they are trying to encourage some economic activity by lowering the federal funds rate. But like I said, unfortunately, that doesn't cure the coronavirus. The coronavirus is something that is really having an impact on our economy, and in my opinion, is going to lead us into the recession that economic experts have been talking about for so long. As you're seeing right now, a lot of people are just staying home. They're not going to restaurants, they're not going to bars. And when people aren't going out and spending money, doing social gatherings, obviously that can have a ripple effect and start to hurt businesses' revenues and incomes. And if that happens for too long, eventually companies are going to have to start laying people off, and that ticks up the unemployment rate, and then it just kind of leads us into this downward spiral, or this pattern where we enter into the recession. Okay, so the coronavirus is probably going to be the cause of the recession this time. I'm sure a lot of you have probably already figured that out already. But I wanted to explain why that's important. So overall, it's not the Fed rate cut that is controlling mortgage rates. Yes, mortgage rates will respond to that, and often they will eventually follow direction of that Fed rate cut, but it takes time to get there. I just don't want you to think that because the Fed cut the interest rate to 0, that mortgage rates are 0. Okay, again, that is a totally different thing, and it's relevant to mortgage rates, but it doesn't mean that mortgage rates are 0. Okay, so make sure you're clear on that. The other thing that the Fed announced this past Sunday is they're announcing some quantitative easing measures. So what the Fed is doing is they're buying $500 billion of treasuries and $200 billion of mortgage-backed securities. And mortgage-backed securities is really what controls interest rates. I mean, yes, the mortgage-backed securities and treasuries, they are interconnected, or they're related there, but it's really mortgage-backed securities that set mortgage interest rates. So when the Fed is purchasing mortgage-backed securities, actually, let me back up a little bit. Let's talk about what happened last week. Last week was a horrible week for interest rates. Every day we just started to see mortgage rates increase every day. And the big reason that was happening is because more or less, banks kind of ran out of money to lend out. Okay, we had seen a huge spike, a huge surge in mortgage origination activity, and eventually we got to a point where, I mean, we originated more volume ever in history. Okay, I think like the record before this was like $4 billion, or yeah, I think it was like $4 billion in locked volume on a single day. There was a day, I think it was the second week of March, where the industry had locked almost $10 billion in mortgage origination volume, like just unprecedented. So how does that impact your interest rate? Well, what happens is there's so much mortgage origination volume, but there's only a limited amount of banks that exist to, fund those loans and purchase those loans from the secondary market when they're originated, right? So eventually you get to this point where so much origination volume is happening and there's a limited amount of buyers to actually purchase those mortgages. So what that means is we've got now a surplus or an oversupply of mortgage-backed securities in the marketplace. And when that happens, the price of bonds comes down, which causes interest rates to go up. Okay, mortgage-backed securities and interest rates have an inverse relationship. So the higher that mortgage bonds are selling for, the lower interest rates will be, and conversely, the lower that mortgage bonds are selling for, the higher interest rates will be. So what that means is, because we're dealing with this surplus, this huge demand, or this surge of mortgage volume in the industry as a whole. Like, this isn't just Nova. Every single company is facing these capacity issues and these volume issues. What that means is there's just too many mortgages being originated and not enough buyers to purchase those. So that decreases or diminishes the value of mortgage bonds, dropping mortgage bond prices, which causes interest rates to go up. Okay, so I know that was a long explanation. Hang in there with me. And why that's important is because the Fed announced those QE measures. When they're coming in and saying, hey, we're going to buy $200 billion of mortgage-backed securities, and they bought $40 billion on Monday, the Fed's a huge buyer, right? So when they're purchasing, that is help easing some of the mortgage origination volume that is happening right now, and it is adding liquidity to the market, meaning that that causes those bond prices to go up and interest rates to come down, because now you've got another buyer in the marketplace. So that's why the Fed is stepping in and doing some of this, because they're trying to add liquidity to the market to make sure that we can keep lending and things like that. Okay, so that's ultimately, like, kind of broad picture what's going on, and that is a huge announcement. And that's a big reason that I think interest rates are going to start to come down again. You have not missed the opportunity to refinance, but I just need you to be a little patient, because right now we've got this huge backlog. Every lender has this huge backlog of loan originations that they locked in the weeks prior that we've got to work through. And as we work through some of these loans, we start closing some of these loans, the Fed continues to buy mortgage-backed securities. That's going to add further liquidity into the marketplace. So we will see interest rates come down, but right now is just a tough time because interest rates have, like, it's amazing to see how much they've gone up just in a short period of time from the volume that has happened. But you have not missed the opportunity. We will have another opportunity. We just need to be patient and make sure we lock on the right day. So a couple other things here. Again, I know this is a long video, but we've got a lot to cover. The Fed removed capital reserve requirements from the banking institutions. So what that means is, in the past, this came out from Dodd-Frank in 2008, saying, hey, if banks are going to lend out money, they've got to make sure they have enough cash on hand to help cover the money that they're lending out. So the general rule was they need to have 10% cash available of the money that they're lending out. So if they're lending out $1 million, we need to have $100,000, no, I apologize, $10,000 in cash reserves for the $1 million that we lent out. Okay, so it's just a 10% rule. Well, what the Fed did is they removed that restriction, and because of that, they were able to add some additional liquidity into the marketplace this past Sunday. So again, really important, really good stuff for mortgage-backed securities. The last one that was, in my opinion, a really important measure that the Fed did is, in the past, when you refinance, when you pay off your loan, when you sell your property, when you make principal payments on your mortgage, right? Well, that mortgage is part of a big pool called mortgage-backed securities. And what happens is, as those bonds that are in that pool mature or pay off or whatever it is, the Fed would reinvest those earnings, they'd reinvest those gains into something, right? In the past, they've been purchasing treasuries with that, so that's a big reason we've seen the 10-year yield come down, but mortgage interest rates, mortgage-backed securities haven't really been following that. Well, what's happening now is the Fed is now going to start reinvesting those returns or those gains back into mortgage-backed securities. So that's huge. So even though they're buying $200 billion of mortgage-backed securities, they're also going to be reinvesting the gains from when those bonds mature or get paid off or whatever it is. They're going to reinvest that back into mortgage-backed securities, again, adding greater demand. So the prices of those will increase. The price of mortgage-backed securities will increase. Interest rates will fall. So again, we know this is about to happen. It's probably going to be about a couple weeks out, 30 days out. At least that's kind of my expectation for when I think that interest rates are going to start to come down, especially as we continue working through this backlog of locked loan volume. As an industry, we just got a lot to catch up on. So I do feel like in the weeks ahead, the days ahead, who knows when we get there, we're going to start to see some improvements in pricing as we work through this backlog of volume. Lastly, the market has been incredibly volatile lately. Things are moving at a blistering pace. It's not uncommon to see multiple reprices throughout the day, which, for the most part, when a lender issues a rate sheet, that rate sheet is good through the end of the day because there's not been a ton of volatility. But with everything that's going on right now and the speed of information that's coming out and how bond traders are responding to this information, how stock traders are responding to this information, things are moving at a blistering pace. So what that means is we really, really need to be in a position to lock in your interest rate, because we may only have 30 minutes to an hour to actually put that rate lock through. And it's not just your mortgage. There might be 50 other customers that we're trying to get back to lock in an interest rate. So the reason I'm telling you this is because I need to make sure that when it comes time to look at an interest rate, look at your refinance, we need to be in the best possible position to put that rate lock through, because we are going to have probably a short period of time. You got to think about this. As we close loans, okay, and we add liquidity back into the marketplace, we're going to see those interest rates start to improve. And what that means is there could be a good day where there's a big spike of mortgage demand or people buying mortgages, which is going to cause interest rates to come down, maybe for a couple hours, maybe for that day, maybe for a few minutes. But we do know that when it happens, sometimes, at least right now, it happens very quick. Okay, so what that means is we need to be in the best possible position to actually lock in your interest rate. I cannot lock an interest rate unless we have a complete application and a credit report. Now, obviously, I know we don't know what those interest rates look like yet, but it might be something where you're going to get a call from us and say, hey, here's where we're at, this is what we need to do, and we need to be in the best possible position, because if that sounds good to you, we want to lock your interest rate right then and there so that we can get on to the next person to make sure that we can also lock their loan, okay? As opposed to, calling, waiting an hour to think about it, and then submitting the application, and it takes us 2-3 hours to get all that information done. We can only get to maybe 2 or 3 people a day. So in order to help us keep up with demand and the surge of volume that we're seeing, we want to make sure that your application is done, or at least this is how we're going to be handling things in order of importance. We're going to prioritize people that have completed their application and given us permission to order a credit report. Okay, so if you don't want to do that, if you just kind of want to see where it's at, just know we'll get to you, but we won't be able to prioritize locking your interest rate over somebody who has given us permission to pull credit and have already submitted a loan application. There's no cost to the loan application. There's no credit report cost. Really, all we're doing is we're just trying to tee you up. Okay, so when we see that improvement, it's like, boom, we can just call and get you locked in. Okay, so that's going to be really important. So in order to help us out with that, we'd like you to go onto our website, coloradoloanofficer.com, complete the online application, give us permission to pull credit. A credit ding, if you're worried about that, it's about a 2 to 5 point hit. It takes about 30 days for that hit to actually show up and have an impact on your score. And a lot of times, just by making 1 month of on-time payments is going to completely offset that 2 to 5 point hit. So it's not as severe as what most people think. If you're really concerned about it, we can start with a soft credit pull. And we can send you a soft pull authorization link and start with the soft pull if you just want us to run that first. It's totally fine. We just want to know what your credit score is, because obviously interest rate pricing depends on the credit score you have. So just know, in order to actually lock the rate, we will need a hard credit pull through all 3 bureaus, and that updated application is going to be really, really important. Additionally, we would like to receive a copy of your current mortgage statement so we can just know where your principal balance is. We don't, obviously we have amortization schedules. We can kind of project where your mortgage balance is, but if you've made additional principal payments, if you have an escrow shortage, that's really valuable information for us to know when we're putting numbers together for you. So that would be huge for us if you could email us a copy of your mortgage statement, or I'll include a secure web portal link where you can upload that mortgage statement below in the body of this email. Also, lastly, let us know your goals for the refinance. Are you looking to go into a 15-year, a 20-year, a 30-year? Are you looking to pull cash out to consolidate debt, do a home improvement project? Are you just looking to get your interest rate down, drop mortgage insurance, whatever it is? Type that in the email. Let us know, like, hey, we're trying to shorten our term, or we're trying to lower our interest rate, or both, right? So give us some additional detail or flavor of like what you're trying to accomplish in that email, just so we have a record of that. We can refer back to that when it comes time to make that call and say, okay, now's the opportunity. We got to do this now. I think that's about it. If you have any questions on this, let me know. I hope that you found this video helpful. Please hang in there with us. We are doing our absolute best to get through everybody, but in the past week, we've had about 150 people reach out to us for refinance inquiries. You are incredibly important to us. We love working with you. Thank you for reaching back out to us. It just shows that you are a loyal client, and we appreciate having you. So anyway, just know, like, we will get to you as soon as we possibly can. But in order to help us keep up with volume, keep up with capacity, make sure everybody has a chance to take advantage of these great interest rates, the loan application and the permission to pull the credit check is going to be really, really important for us, because we will be prioritizing people that have done those steps over like we're not super serious about refinancing yet. So hopefully that makes sense. Lastly, let's talk a little bit about the forecast, where we're at. Are we going to be okay? Like economy, things like that. So I heard a statistic the other day. There are about $7 to $7.5 trillion of mortgages in existence throughout the United States. Okay. The mortgage industry right now is staffed appropriately to maybe handle about 2 trillion of mortgage volume in a year. Okay. Out of the $7.5 trillion in mortgages, when those interest rates drop, about 2/3 of those easily are going to qualify or be eligible for some sort of refinance, whether that's a rate and term, cash out, something like that, right? So what that means is the mortgage industry is staffed appropriately to handle about half of the volume this year that is going to be surging through our pipelines, okay? If you know of anybody that is either looking to get into the mortgage industry or is in the mortgage industry, not super happy at their current company, give me a call. Please let me know. I'd love to bring them on board to Nova, get them started, whatever it is, but that will help us also keep up with capacity, make sure that we're getting back to all of our clients, all of our customers in a timely fashion. So yeah, don't be afraid to reach out if you have any recommendations for that. Also, just because interest rates were super low and then spiked, and then they're going to be low again, and they're probably going to spike again, and just because of that volatility, I don't want you to think that you're going to miss the boat. Okay, we have time. The coronavirus, the impact of the coronavirus, this recession that we're heading into, this is not an easy problem to fix, and it's not going to go away anytime soon. Okay, so we're going to have the opportunity. You're going to have at least the forecast right now, rates are going to be low for the next 12 months. Okay, so we do have that time. We do have that window of opportunity to get your refinance done. I promise we will get yours done. We will save you money on your mortgage or whatever you're looking to do. We'll shorten your term, whatever it is. So anyway, just all of this kind of coming together. I wanted to send out that video, kind of explain where we're at. We are absolutely doing our best. Me, my loan partner, Katie, we're doing our best to quote people out, get people locked. Please help us by completing your application and giving us permission to pull that credit report so that we can make sure we lock everybody in that we can when the time is right. So if you have any questions whatsoever, please give me a call. We will have this opportunity. If it's something where we haven't gotten it done yet and we need to just be a little patient for this market to recover, we will get there. So anyway, help us do that by getting your application done and submitting giving us permission to do the credit check so that we can get you locked in once we see the opportunity. We want to take advantage of that. So I'm on standby. Phone number 720-590-2492. The team line is 720-593-6682 or 720-593-NOVA is an easy way to remember that. Our team email, wilcockteam@novahomeloans.com. And thank you guys for watching. Thanks for hanging in there. I know this is a long video. Appreciate your attention. All right, we'll talk soon. Thanks.